talking earlier around the Fed and Europe, and you have went through and basically said it doesn't matter that they go 1 or 2. We're near the end of the cycle, the tightening cycle.
Yeah, I think they're near to the end of the tightening cycle, and I want to emphasize that the Fed has been in what we call a risk management mode of operation since November last year. And the key thing is, I think if you look at the minutes from the last November meeting, and they made a very clear message that fighting inflation is not the only aim. It's not the only goal, and that actually is very important to assess whether they have been doing too much or doing too little. At that time, they start mentioning about the risk of a slowdown, and they're not sure yet. I mean, the staff gave a report saying that okay, maybe, but the officials, the voting member, certainly did not say there's a risk of recession at that time. And then the second things they also mentioned the risk is financial stability. They actually mentioned about they need to watch financial stability back in November. So that's actually from all the way from November to now, they are managing the risk to balance the risk of fighting inflation being, and at the same time, whether there's the economy slowing down more than they want to see. They definitely want to see a slowdown, but how much? And there's also financial risk, financial stability. So this, if you're from yesterday's statement, they're talking about the same thing.
Talking about financial stability, and I have to wonder, just all the concerns that we had about the Treasury replenishing its cash and its coffers, and whether we are going to see that sort of liquidity crunch. Have we seen any signs of that?
I think for the data we have seen so far, that's up to the 14th of June, and we'll be seeing new data tonight. And actually, that concern is a little bit overblown. In fact, liquidity has not really come down in the banking system. And why is it so? Because it's when, yes, the Treasury increased the cash balances in what we call the TGA, the Treasury General Account at the Fed, so taking money out of the banking systems. There's about more than 80 billion since the beginning of the month until the 14th of June. But at the same time, a lot of those issuance, actually the T bills, they were all bought up by the money market fund. And the money market fund, they have two major investments. One is T-bills, one is the reverse repo at the Fed. And so they actually reduced the investment in the reverse repo with the Fed that's paying, they are getting 5.05, but in the T-bills they got.
I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
so you disagree with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift.
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well,
so what
I had no part in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated. In housing in particular, there is housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was, with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Anastasia, from your vantage point, do you agree that if 10-year yields start to rise, if people's longer-term inflation expectations and rate expectations rise, that will be the game changer for risk assets?
I think it would, Lisa. That's one of the big reasons why tech had the rally that it had earlier this year, is because multiple expansion as the 10-year yield was declining. I mean, I do agree that if the 10-year starts to rise, we're now repricing the longer-term inflation expectations. And fortunately, in the United States, what we've been recently repricing is the growth expectations. That's what drove the 10-year yield from 3.4 to 3.7%. But to the extent that the 10-year starts to rise because, all of a sudden the inflation expectations start to become more entrenched, that would certainly cause a problem for risk assets. And, to kind of go back to the point, Lisa, you were making about the UK CPI, I mean, it is stunningly high, but I also think it kind of showcases how the Fed has actually done a good job of getting ahead of the curve finally. I mean, if you look at the UK, you've got the inflation rate at 8.7% and their Fed funds rate equivalent of 4.5%. Now, that means that the rate is below the rate of inflation. That's not the case anymore in the United States. And the Fed at 5.25%, 5.5%, that's over and above the core PCE inflation of 4.7%. So that, to me, really sort of demonstrates that the Fed actually has finally done a good job of getting ahead. And I think that notion will give the Fed the opportunity to pause over time. And for investors, global, seeking to allocate to global equities, that's why they're going to continue to prioritize U.S. equity.